Hi, good morning. It's good to see you again. I'm R.N. Bhaskar from BKBB, which is an acronym for Bhaskar Ki Business Batein. It's a channel that brings you every week a policy analysis, an occasional story, and an occasional conversation. But at 8:15 in the morning on weekdays, Monday to Friday, we bring you news behind the news. We take up a few headlines that we think are interesting and we analyze them for you. And my co-anchor today is Anurag. Welcome, Anurag. Good to have you here. And the headlines that we shall discuss among ourselves, between ourselves, are first, you have the issue of Trump, how he's trying to push agriculture desperately with India and Japan. And the second is corporate bonds, which have suddenly found flavor. And the third is the government's plans to boost R&D and employment through a large allocation of funds. Is it large? Is it enough? We'll discuss that. But let's take the first story first. Before I go to the story, just a reminder, please click the subscribe button. Please click the like button. And most important, tell your friends about us. Okay, let's see the first story. The US started arm twisting Japan to immediately accept US rice. That is a sensitive subject for Japan because rice is a staple food and a large percentage of Japan's population is engaged in rice cultivation. If you start importing rice, it'll hurt the farmers, it'll hurt the elections, it'll hurt politics. Rice in Japan also has a special pricing, and they do not want any imports to affect either the employment of farmers or pricing. There's a possibility that US is pushing Japan to import rice to make sure that it achieves another objective. It does not want Japan to increase its interest rates. Japan said it would. America, privately, through officials, has said that we will recommend Japan's monetary policy if it does not do so. Why? Because if Japan increases interest rates, investors will go to Japan for investments and not to America, and America will get hurt. America's already reeling under the shock of bond rates. So, the US pressuring Japan for agriculture could be a kind of a strategy to achieve another objective. In India, however, the situation is far more dire. America is looking at India for farm export from Japan from the US to India, and also dairy exports. And I mentioned on this channel before, dairy is a sensitive subject for India because it's a backbone of Indian rural sector. It accounts for a GDP share which is larger than rice and wheat put together. And the Commerce Minister Piyush Goyal made a mistake of trying to almost agree to New Zealand exporting milk products into India under the RCEP negotiations a few years ago. The whiplash was so severe that they immediately disengaged themselves from those discussions. There's a second problem. Once you import agriculture, you hurt the Indian farmer. You import edible oil, it hurts the Indian farmer because the edible oil seed producers, the farmers, suddenly find the prices have crashed and they can't sell the seeds. And do remember, unlike industry which sells its products round the year, agriculture gets its money only once in a season. So I plant today hoping to get my money 6 months later. If suddenly 6 months later I find the prices have crashed, I've lost my whole year's earnings. And India is an agricultural country more than Japan is. So India's fighting hard. But as I said, the US has tariff power because it also blackmails Indian politicians and policymakers. Which way things will go, I don't know. But desperate, but the US is actually serious about this because it's losing ground in USA itself, where prices are rising, and it needs to make sure its own agricultural lobby is satisfied. And the agricultural lobby, which is a large voting base, does not go against Trump. Difficult times for Trump, but more difficult times for Asian countries. And that takes us to the next story. And the next story is by Anurag. Anurag, can you come in?
Good morning. Corporate bond issuances have reached an unprecedented high in the first quarter as companies accelerate their borrowing plans and tap the debt market earlier than usual. This front loading of borrowings marks a significant shift from past years, when most corporate fundraising through bonds would typically pick up only in later quarters. The main driver behind this change is the recent policy environment, specifically the RBI's rate cut in the previous month and increased liquidity in the financial system. These measures have pushed bond yields lower, making it cheaper for companies to raise funds through bonds compared to traditional bank loans, where lending rates have adjusted more slowly. Another factor at play is the anticipation of potential changes in the global interest rate cycle, with central banks in developed economies signaling a pause and even a reversal in rate cuts. Indian companies are moving quickly to secure funds at the current rates. This strategic timing is not new. Similar patterns were seen during previous times of monetary easing, but the scale and speed of this year's issuances stands out. Despite the strong activity in the primary bond market, trading in the secondary bond market remained muted. This suggests that while companies are eager to borrow, investors are still may still be at cautious, possibly due to concerns with global economic stability and geopolitical risks. As the quarter closes with record fundraisings, the key question is, will this early surge lead to a quieter second half? Or does it signal a long term change in how Indian corporates approach debt markets? What's your take on this, sir?
Anurag, a very good story. Yes, corporate bonds are gaining traction in the Indian market, but there are two issues. One, corporate bonds are coming at a time with lower interest rates to attract industrialists, but the money is already awash. The entire sector, if you look at the number of notes that RBI has printed, it's more than even the GDP growth rates. So there's money in the market. You've reduced interest rates when you should be holding interest rates. So that means you'll have more money going out in the market, which eventually will trigger inflation. And when inflation comes in and interest rates remain low, it will compel interest rates to go up again. India has to work very carefully on this reduced interest rates, which have made corporate bonds very attractive. Interesting, but watch this space. Thanks, Anurag. Great. And there's a third story, which is about education and jobs and research and development. The government has allocated 2 trillion rupees, and that's about 2 lakh rupees, 2.07 trillion, for creating jobs and investing in research and development. How do you create jobs? You create jobs by attracting investment. How do you create investment? How do you attract them? By making sure that the investment atmosphere is good. Today, private investors are not investing in India, they're investing overseas. And overseas investors are not very happy about the Indian situation and are staying away from it. So, if you don't get investments and just create a fund for creating jobs, jobs don't get created. Maybe the government can create jobs and the government will take the money that is itself allocated. But that is not a good answer. The government is never the most efficient user of capital. And there's a second problem. You've allocated months to research and development, great idea. You need research and development, especially a pharma, where we depend on intermediates and APIs from China. But creating those facilities again requires investments. Just an R&D sector does not work. It has to be dovetailed with investments. And that is why the plans look good, the allocations look okay, not very much. But I'm a little worried about how the government is going to go about creating jobs. Even R&D becomes difficult. R&D is difficult for the two other reasons. One, in India, only 0.7% of GDP is the R&D spend. R&D translates into higher manufacturing, higher production. The R&D expenditure in India is estimated to create just about 36% to GDP. This is much lower than 70% for the USA, 79% for China, and 57% for the EU. India lags behind. Yes, R&D is required, but beyond R&D, you need to have more investment. Will the government work on that as well? And that, in a way, brings me to the end of today's session. But first, a reminder, click the subscribe button, click the like button, and tell your friends about us. And then the second part is, let me take up some of the questions that have started coming in. Why is the government not tabling the trade policy in the parliament for serious discussion that affects farmers and employment? In fact, the government should be more open. All trade talks, all purchases, whether the purchases of the Rafale, or the purchase of the Boeings, or the purchase of any other thing, was done without parliamentary discussion. Lately, crucial matters are decided by core committees within the government without taking to parliament. Trade is a very important matter. And whether you should trade with the US or with China or with other Southeast Asian countries is a matter that parliament needs to discuss. At present, the government's myopic vision makes it look only to the West. It has not looked at new markets. It's still looking at countries that have seen shrunken markets. Anyway, let's take the second question. And the second question is, what about venture capital? Yes, very good question. The 2 trillion rupees which have been allocated is to be given to apex institutions at a discounted price, which in turn will give it to development banks and development institutions, which in turn will pump in the money. Some of it may go towards venture capital. We need venture capital. India's future job market does not depend on jobs being created, but people becoming entrepreneurs themselves and creating jobs. But for that, you need to work on education also, and the government's forgotten that. You can't have a healthy employment market without good education. And the next one, will the government's allocation of funds be attractive this time for creation of employment opportunities? As I said, funding is not enough for employment opportunities, and investment climate is more important. When a businessman knows that the investment climate is okay and the laws will not change again and again and again, he'll bring the money and create jobs. You don't need the government. The government's job is good policy making. If your policy is bad, job creation is bad. And the last part is, will there be inflation? Yes, there could be. We've disguised it by pumping in more money. You think the prices will come down? In fact, it's going to be quite the opposite. Whenever there's more circulation of money and less production, it leads to inflation. Simple, basic economics that every school kid is taught. Anyway, that brings me to the end of today's session. And I'm delighted to have you here. Do log in again tomorrow morning. And as for the day, have a wonderful, successful day today. Take care. Good luck.